Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Hello there. It's back to school season, and we're back with a great lineup the next few weeks, starting with a live panel event in Philadelphia, Wednesday, September 13th. We'll record that and put it up later this month, but hey, if you're in the Philly area or close by in New York or New Jersey, come stop by, say hello, and hear yours truly here moderating a panel with Tim Pickering of Auspice, Corey Hofstein of Newfound, and Brian Malone of Campbell & Company. Go to rcmalts.com/Philly to sign up. That's PHILLY, Philly, to sign up. It's free. On to this episode, where we continue on our 2-week mini sprint in the alternatives ETF mutual fund space, talking with Russell Kellites, the PM for the AlphaCentric Premium Opportunity Fund, ticker HMXIX. We get into Russ's background as a computer scientist, what's going on in San Francisco. We talk Uncle Warren selling naked puts, then dive into the various option strategies Russ uses in the fund to do all sorts of things like market participation, upside capture, and downside protection. Send it! This episode is brought to you by the Philly event I already mentioned, so go sign up, rcmalts.com/Philly. And now, back to the show. All right, hey everybody, we're here with Russ Kellites, or Russell. What do you prefer? Russ? I always call you Russ.
Doing? Sure.
All right, we'll go with Russ. Thanks for being here. Where are you in your lovely home there? San Fran?
I am right in the middle of San Francisco.
So is it as bad as everyone's making it out these days?
That's a great question.
I get the same question every time from Chicago, right? We just had
Yeah,
woman snuck a gun into the White Sox game under a fat roll. She put a
Wow.
gun under a fat roll to get through the metal detectors and then shot someone during the game. So we got our own problems here in Chicago. But sorry, so
Yeah,
used to that question. So
we
I
haven't
get
had that happen. Parts are pretty bad, but the main kind of residential areas are really fine. In fact, the area I'm in is, really perfect. We've had very few problems.
But have you seen people like moving out en masse, or is it contained? Is that just in the headline?
Not really. Again, I think some of the areas that were sort of hard hit were kind of the downtown financial district, Soma. I think was hit pretty hard. We actually had a kind of an odd incident the other day here, which is unusual. Someone was carjacked. 5 people jumped in the car and drove down a street that actually, how we've got all these hills, and this particular street just sort of ended. There was a staircase and it picked up down below. Well, they drove right off the end of the street. So the car careened off of that, did a somersault. It was probably about 3 stories high, and landed on its roof.
Whoa. Wasn't like the 70s car chase movies in San Fran?
It looked a lot like that.
We had the commercial real estate guy in the pod a while back. He was like, he wouldn't buy commercial real estate in San Fran, Chicago, or New York.
Yeah.
So we feel your pain. But yeah, I'm fine. I'm still living here in Chicago. Can't scare me away.
Well, this made the news and everything. I'll send you a link to it.
Yeah, send a link.
After our event here.
But you went to school in New York, correct?
That's right.
So what was that like? You grew up California, went to New York, or
No,
grew up New York and ended up in California?
I was actually born out west. I was born in Hawaii. We moved around a lot when I was younger.
Army brat? Or Navy brat?
My dad worked for Pan American. So we were up in Seattle a little bit. We were in California. We actually lived in Afghanistan for a couple of years.
Really?
And then moved to Long Island, New York.
Yeah.
Where I mostly grew up. And then I went to Manhattan for school. And I went to Columbia, and I got a bachelor's degree there, entered a master's degree program. That was all in computer science, focusing on AI. doing research in AI, and then went into the MBA program and got an MBA in finance and marketing.
Nice.
Yeah.
And not to insult you right off the bat and call you old, but right, what was it like back then with the computer science and AI versus today? Right, must be vastly different, or you think the nuts and bolts of it were pretty much the same?
Well, we were really kind of at the early stage of, the building blocks of what you see now. So, something I was particularly interested in was in natural language processing, which is, the recognition of text, words, etc., as opposed to, computer programming and direct database access. So, for example, we would work on a zoology database where you could query the computer, how many legs does a panda have? And it would answer a panda has 4 legs, which was, really kind of a pronounced step forward at the time. Of course, now we take that for granted, and with Chat GPT 3.5 and 4 and some of the others, the computers have really gotten, much more advanced than that.
Do you think it's mainly the processing speed and what they're able to do on the back end, or is it they've made leaps and bounds on how it's handled? Right, I'm sure you were dealing with much slower speed in order to run those queries and whatnot.
Oh yeah, no, the compute, as they call it, is increased dramatically. We really were bumping up against the upper edge of what was possible because of computation speeds. And of course, now I've got more power in my iPhone than I do in the, we used digital equipment's DEC 20s back then. So there's a huge movement forward.
The pod last week on the power trader, and he was quoting that it's 10 times the amount of energy is used for a AI query than a normal Google search. Right. So, and then it's like something like 100 or 1,000x, I can't remember, to actually train the model.
Right.
So it has consequences. All this electricity we're using, all this power, all the chips we need, all the materials to do the chips, all that.
That's right. Yeah. I mean, I listened to someone the other day who was saying that Chat GPT 4 took 10 times the resources of 3, and 5 will be 10 times 4, etc. But the results that you get out of that are tremendous. I mean, some industry leaders are suggesting that the reduction in workforce utilization is something like 30%, kind of across the board for all these kind of more sophisticated human resource intensive roles, marketing and consumer
lawyers,
communication, lawyers,
accountants,
doctors even.
So what made you go down the finance path instead of the computer science path? Something in there said like, this isn't for me.
It really was that we were bumping up against the edge of what was possible at the time. I mean, we spent tremendous amounts of manpower getting to the point where we could build this sort of a database and be able to access it through a natural language. But it looked like the next big movements forward, the next big leaps were probably going to be 10 or 20 years off. And I just didn't think there was a lot of return in spending a lot more, spending the next 10 or 20 years making these very small incremental gains. And finance numbers were really pretty interesting to me. So I went to business school.
And then out of there, got into, where was it, Goldman Sachs?
Right.
So you must have been doing something right to catch someone's eye over there.
Well, I think large financial firms are really just kind of catching up to the progress being made in the computer side. So they were looking for people that had technological capabilities and we're good with numbers and that sort of thing. And so,
Right, just like they're looking for high-end coders and whatnot today.
yeah, it's really, frankly, it's been pretty consistent. It's been a good way for them to try and separate themselves to get some competitive advantage.
So take us through the backstory from got entry level or whatever level job at Goldman through the next stages to eventually starting your own fund, running your own fund.
Well, I moved around Wall Street a little bit. It was Goldman and then Merrill and some bulge brackets and boutiques. And I guess my last job at it was a international investment bank. I was running the structured finance group, so we were doing cross-border complicated trades involving derivatives and accounting and tax and things like that. And I've been trading for my own account for a long time. And in fact, I was doing some option strategy trades, and there were really kind of two components to it. One was picking an instrument, a stock, and the other was the structure around that stock. And it involved primarily buying puts and calls. And my technique for choosing stocks was working pretty well, but I wasn't really making any money. And at the same time, we were approached by actually it was Goldman, who was doing large trades for Berkshire Hathaway. And you can go back and see this in the press at the time. But Warren Buffett was selling large out of the money put options on major indices. It was the S&P, NASDAQ, Russell, the Nikkei. I think he was doing something in Europe as well.
Not Uncle Warren. He's famously like anti-derivatives to the general public, even though on the back end.
Yeah, he didn't like him. He sold them.
But he's selling. He was selling puts.
Yeah, exactly.
Naked.
And so they were $1 billion trades, I think, at the time. And so Goldman was the other side of these, but they were running out of their the exposure they could take to warrant to Berkshire Hathaway. So they were looking to offload that. And so we did some analysis looking to take on that exposure from them. And it was, around then that I realized, or in fact, it was then really that I realized I was just on the wrong side of the trade. When I was buying, I really should have been selling. And so I kind of revamped that half of my equation to more focus on the premium collection, the premium writing.
And you're saying from a flows perspective, or just you saw Warren earning premium and said that might be a better gig? Yeah,
it was really that. It was, he's obviously a really smart guy, and if that was the side of the trade that he was on, it's a good reason to think it's a good side of the trade for me to be on.
Good way to look into it more.
Yeah.
And so then said, you peeled out of whatever firm you were and started your own?
Well, so this was end of 2007 going into 2008. So there was, as there was this, financial meltdown.
Yeah, hopefully you didn't sell puts right there.
My group was eliminated. So at that point, I just turned to trading for my own account.
And then eventually said, hey, this is good enough. I'm making progress in my models to roll it out to customers.
Right. So, I've been helping out friends and family, and in 2011 that turned into a hedge fund. In 2016 we turned the hedge fund into a mutual fund, which is the fund we're working on now.
And it's AlphaCentric Premium Opportunity Fund.
Right.
So the idea behind the fund and your overall strategy. So, let's back up. How different is what you do today from what you were originally thinking up and designing for your original fund?
So I developed a model to analyze what the best positions, options, strikes, expirations were to buy or sell back tested that, and then ran it through an AI engine for further refinement. And that's really been, that model has really been the cornerstone for what we've been doing ever since, and that really hasn't changed.
And was it the entire universe of single name stocks, or you started it?
They're really just the S&P 500.
Got it. And it ingests the entire universe of strikes and tenors?
Right. Yeah. And the advantage of that was that there's a lot of liquidity. The premium options were really pretty consistent. And there were just a lot of strikes and expirations for us to work with. And so that's changed a bit. We went from really kind of monthly expirations to weeklies, and now really pretty much dailies. So there are really strikes for every day of the week. And so that's given us an opportunity to take more positions and further refine what we're doing. And we've also refined our hedging strategy a bit, really quite a bit, as a reaction to what happened to the market in 2018, where we had, you may recall, 𝐈𝐬𝐸. When the market dropped about 4%, but volatility spiked, actually went up 100%, over 100% on that small downward S&P move.
Real quick back up. That's interesting. I hadn't thought of that. Of like, if you're feeding this data into an AI model, could be an argument of like, I don't have enough data from monthly expirations to give the model enough to work with. Now you're doubling it with twice a month. You're quadrupling it with weeklies. You're whatever the number is, 16th thing it with, or 20th thing it with dailies. So now the model has even more and more data to work with, and it can be better refined. Right? So there's some sort of statistical significance in there of like, the more data I have, the better.
That really hasn't affected so much how the model works. I mean, we're really looking at things like what what the movements in the markets are like, the volatility market, say, versus the amount of volatility priced into the options, and then looking over the landscape of that to see where the mispricing is the greatest, where we can take the best advantage of that.
Now you're not an option guru unless you call it the vol surface.
I was trying to avoid the lingo.
That's all right. But yeah, like, right. And I think of those 3D heat maps of Yellowstone or something, right? Of like all these peaks and valleys and blue and orange and red, right? Of like, that's what the vol surface. And you can say, okay, this doesn't make sense on this one slice.
Right.
It should maybe be gently rising, gently falling. You could have some slope, but if there's a big peak and a big valley on one slice, right, something's amiss there.
Sure. And the heat map tends to have a sort of a gradual gradient type pattern, but you still look at where the price is high at one expiration versus low at another expiration, and take advantage of that.
And so it strikes me that it's, pun intended, strikes me that it's not that easy, right? Like, so just because one's more expensive than the other doesn't necessarily mean the one's overpriced and the one's underpriced. There may be good reasons for that. So kind of, how do you view that of like, okay, the market is pricing it there, right? So do I have a better model? Am I identifying just the mispricing, or am I identifying an opportunity?
Right. Well, we feel like if we're taking into consideration the, kind of the known external factors that are going to affect the market, and we try and take a balanced approach. So rather than just kind of selling something outright, we'll buy another thing to hedge. So even if we're wrong, we're really trying to look more at the differential between those things rather than kind of the absolute of one thing versus another.
And that's a good segue. Is that why options instead of, right? You could have run single stocks into the model. You could have run global stock indices, been long or short stocks, or right. Why did you settle on options? Because it's cliche. It gave you more optionality. It gives you more, like you were talking about. I can I can know that my loss will be truncated here because I just spent premium. I can.
Yeah, we found that the liquidity and the consistent differential between the amount of risk embedded in the market versus the amount of risk you're being paid for in the options, that differential tends to be pretty consistent in the broad indices, whereas it can move around a lot more with individual stocks. And with individual stocks, you get that idiosyncratic risk. It's just really hard to tell what's affecting an individual the could be, the CFO is about to step down, or he's got some health problem that isn't widely known. Earnings miss could come out, or earnings beat could come out. There are just so many factors that can affect an individual stock, whereas the broad market tends to diversify all those little idiosyncratic risks.
I could argue that these days, like those top 10 stocks have mastered taking away all those idiosyncratic risks, right? That's why they just keep getting bigger and bigger. If you're $1 trillion company, you're not going to move 10% in a day on some unknown risk, right? They're going to telegraph.
Yeah, well, look at NVIDIA.
Yeah,
just over the
crazy.
last couple of months. They had a month or so ago where they were up, 30-40% or something, and then on earnings they were up 10%. I think they gave a lot of that back, but and that's the sixth largest company by market cap, I think.
Right. But to your point being, it kind of isn't worth it to trade that. Like, if you're right, sure, you're going to make some money, but if you're wrong, you could be really wrong in that scenario.
Yeah. Yeah. I'm sure there are people that, look at the large companies and do the deep dives and, have a really good handle on, what to expect, what's going to affect the stocks, but that's just not how we want to operate.
Right. You want to be the good type of boring, right? So we kind of buried the lead a little bit here, but let's take a step back, take a step up, 30,000-foot view, talk about the trading strategy, overall, what you're trying to accomplish. And then we can dive into some of the details. What's the 30-second elevator pitch on what you're trying to do with it?
Well, I think the principle underlying what we're doing is really taking advantage of that differential that I mentioned. So it's the differential between the amount of risk in the market and the amount of risk you're being paid for in the options. And it's really a lot like, I draw the analogy to an insurance company, say like a GEICO, where, if you have a car and you insure it with maybe GEICO, you are paying them, say, $1,000 a year for insurance. But when they take all the people like you and they add them all up and they average them, the cost embedded in that policy is more like, say, $800. And so they've got this $200, 20% profit margin. It's really the same thing with options. And options is really the only financial instrument that I can think of, aside from, say, an insurance policy, where you've got that positive expected future value on a risk-adjusted basis. So with stocks, if you buy and I sell, if it goes up, you win, I lose, vice versa. And it's a random walk. With bonds, really the same thing. And when you take out the default rate and the recovery rate, you're left with the risk-free rate of return. But with options, you really got that profit margin built in. And so what we're trying to do is find the best way to take advantage of that profit margin, find where that profit margin is the highest, and sell those policies, or where it's the lowest, and buy those policies.
So like GEICO with less funny commercials. Yeah.
Right.
We
don't have a gecko.
And so the whole concept there is I need to be widely diversified, right? So that is the index giving you enough of that diversification, or you're saying it's not just the index, but different strikes, different tenors.
Well, we think the index diversifies out a lot of that risk, that idiosyncratic risk. So, if a hurricane goes through and wipes out NVIDIA's manufacturing plant, that's going to be a pretty bad event, but it's the impact on the S&P 500 is going to be pretty minimal. So we're really diversifying out that idiosyncratic risk.
And then how do you think about that? Shouldn't the option already reflect that pricing, or you're saying there's built-in skew that investors are overpaying for protection or something of that nature that kind of builds this mechanism in?
It's really the latter. So there really are no natural sellers of options, just like there are no natural sellers of insurance policies. I mean, there are natural buyers of options. The market, the value of the U.S. equity market is $30 trillion or some, it's probably even larger now. But so you've got all these insurance companies, pension funds, endowments that are long the market, and so they need to buy protection to protect against downside. Retirement funds need to buy downside so they can, if the market up, they can still pay the obligations they've got to all their insured, all their pensioners. So they're natural buyers, but there aren't really any natural sellers on the other side. And so that's why you've got that embedded premium, that excess, risk premium.
And so talk a little bit, but it's not always like that, right? So in a risk off environment that can get, or vice versa, can move around. So we talked offline, you have a bit of a construct of the market's always in one of 4 quadrants. Can you talk through that a little bit, what those 4 quadrants are and how you kind of view what makes them different and what you do different in each of them?
Sure. So our models are attempting to look at the direction of really the 2 main components of what we're working with: the underlying market and the volatility that's reflected in that market. So the S&P and the VIX for simplification purposes. And so we're looking at whether we see the market going up or down, and whether we see volatility going up and down. And so depending upon that, we'll modulate the amount of risk or the type of positions that we're taking on. When the market's going down, we'll, of course, try and take less market exposure, probably less short S&P put exposure, maybe even go long S&P puts. Similarly, when the market's going up, we'll try and take, long S&P exposure, less short call exposure. And then when we see the volatility going down, we'll try and take more short volatility exposure. We try and hedge that, of course, and the opposite when we see volatility going up.
So I lost the 4 quadrants in there somewhere. So quadrant one
so
is...
the 4 quadrants are, you could say, kind of across the top, it's what's the market doing up or down, and then across the side, it's what's volatility doing up or down. And so you've got these 2 factors times 2 is 4 dimensions.
Got it. So market up, vol up, market up, vol down,
right?
Market down, vol up, market down, vol down.
Exactly.
And so that shifts how often? Monthly, in real time in your model? Does it?
It really varies. There are periods where we'll be in one quadrant, and the most, the quadrant where we find ourselves most frequently is up market, down volatility. And in general, you see those 2 instruments inversely correlated. And that's the case. They're inversely correlated about 80% of the time. But so probably about 65% of the time it's up market, down volatility. Probably another 15, it's up market, up volatility, and the other, 10 each, say, in down market, down volatility, up market, up volatility.
65, 15, 10, 10, 100. Good work. Off the top of your head there. So 65% up market, down volume.
Right.
And I think you answered, I was kind of saying, you're not just at the end of every month saying, where's the market at and redeploying. It's looking at it daily.
Right. So you would ask kind of what the frequency is. So, overall, we tend to be in that up market, down volatility. We can be in that quadrant for long periods of time. If you go back to 2020, from say early March through middle, well, even the end of the year, we really only shifted out of that quadrant for a couple of days, kind of towards the end of the summer, and then a couple of days in the fall. So that was kind of 9 months of the year where we were in one
20,
quadrant. Really
not
pretty.
2020 with COVID. You mean 2019?
No, 2020. Once we got through the big drop in
Got it.
March,
Right.
the market just, we were down with 25-30%. The market just rebounded and really pretty consistently came back.
And so in those environments, and overall, let's take a step back. So you're trying to capture as much of the market upside as possible?
Right, and avoid the downside as much as possible.
And so that seems like makes you different from some of these other, right? So if I hear that up front, I'm like, oh, you're kind of in this hedged equity bucket, right? Of like, I'm participating in equities with a bit of a hedge.
Right.
But from what you said before, that elevator pitch, it's not quite like that, because you have these other option strategies that you're trying to generate some income from and generate some different types of returns than just owning the stocks and hedging them, or owning the index and hedging them.
That's right. The hedged equity funds that we see really kind of have one approach, which they use consistently, really all the time. So they're typically the vast majority of the big ones are long an equity position, and then a lot of them will do a costless collar around that. So they'll buy a put underneath, they'll sell a call up above, and then they'll sell another put down below to balance out the economics. And there are some very large funds that do that. But again, it's just sort of one thing. And so they do well within that, the top part of that band. So when the market's going up and they're up, say less than 5% for the quarter, they'll do pretty well and track the market. When the market's down, between 0 and 5%, they'll typically be down 100% of the market. So you really get kind of that 100% correlation between, say, +5, -5, or wherever they place their bands. Where we're really doing four things to add economics, five things really to add economics to our fund. One of them is this premium capture that I mentioned, where we're selling positions around the market. And so that'll do well as long as the market stays within a band, say, up or down. So that contrasts really dramatically with the hedged equity, which are really kind of linearly correlated with the market within that, ±5%. So we'll have economics really that are pretty consistent from that strategy, as long as the market stays within, up a couple percent, down a few percent on, when we're doing premium collection. It's really a weekly position that we're taking. And we take those positions 3 times a week. So Monday, Wednesday, Friday, we're dealing with the 3 expirations. So we're looking for a minimal amount of market movement over the course of a week. And since we're putting those positions on 3 times a week, we're really rolling the positions constantly. So the average life of those positions is about 3.5 days. So the market really has to move pretty dramatically for those positions to get hurt.
And then is it fair to just say that's classic option selling?
Right. Yeah, that really is.
But on both sides.
Right.
So in theory, you're a little bit hedged there. If one side goes, the other side's going to erode.
Exactly. It's impossible to lose money on both sides. So one side will be profitable. And that's an important part of what we do, but it's one part where there are option premium funds that do just that. And so they'll do that and they'll lever up 10, 15 to 1. There was a fund that got hurt pretty dramatically in 2018. They were levered, I think it was 60 to 1. So they'll take a lot of leverage to get consistent returns, which look really good until something dramatic happens. And so that dramatic event, once in a lifetime event happens every couple of years now.
We
do
will
we just-
put a link. We did a whole, we called it an autopsy. It was the LJM fund. So we have a great
Exactly.
blog post doing an autopsy on that fund's demise.
Right. Yeah, and there were a couple.
Which we'll
that
put
was-
in
that
the
was-
show notes of this. But yeah, like you can get in trouble in a hurry there.
So that was 2018, and there were a couple in 2020 that had the same sort of problem. So that's one part of what we do. Another part of what we do is we look for some market participation, and our market participation component is typically around 40%. So that's going to give us about 40% of the upside and downside, but through the entire range of the market. So if the market's up 10%, it would be 40% of that 10%. If the market's down 10%, same thing. But there we're using our directional indicators to try and modulate that. So we're trying to get a little bit more of that when the market's up, a little bit less than that when the market's going down. And when the market has these long-term trends, we do a little bit better during those cycles. When it's vacillating, on a daily or bi-daily basis, we can get whipsawed and get hurt on those positions. So we're looking for the market to go up, we increase our participation. The market goes down, we lose a little bit more than we'd like.
And that's accomplished via the options or via just holding futures?
Typically,
a little bit of both.
Futures.
Just holding the future. All right. And so sometimes that'll ramp up to close to 50%, sometimes down to 30%.
Right.
In that band. That's
right. It's usually kind of 40% plus or minus 10.
And how did you arrive at the 40% target?
We were looking at the overall risk of our portfolio, looking at kind of how much risk we wanted to take on, and that was where we came out, 40 plus or minus 10.
And I think it
seemed to be a good counterbalance to what other funds in our space were doing. We saw hedged equity funds, for example, that seemed to have kind of that 50% correlation. So that seemed like it would be a good counterpart to those funds.
And then you sort of mentioned it, but is this your understanding? I think it's mine of, right? Some of the hedged equity product, they're selling the call in order to buy the put. So that's capping their upside. So if the market's up 50% a year, they might only get 10%, right? Who knows where that top upside call is, but
depending on what their expirations are. So if they're doing it quarterly, they would be limited to that 5% on, say, a quarterly basis. If it's annual, it would be limited on an annual basis. So a lot of people do sort of a quarterly reset. And it'll be like clockwork. So December 31st, they'll put their positions on that run through March 31st, et cetera.
Right. And I feel like a lot of those programs haven't had a bad run because they haven't seen either this big up market where they got capped out and everyone's like, what the heck, we only made 8%. Why? Or vice versa, of like it goes through that short put on the bottom and the losses, right? Be like, okay, I only lost, right? If they're down 10%, maybe they only lose 8. If they're down 40, they might lose 38. So it seems like a unequal.
Yeah. I mean, there are markets that can be really bad for them, like a market that just declines 5% a quarter, 4 quarters in a row. So they'll be down 20% in a year when the market's down 20% in the year.
Right. No, nothing hedged about it. The versus you guys, because you don't have the full exposure by definition, would be some percentage.
Right. In fact, depending upon the exact circumstances, a slow grind down of 5% a quarter could actually wind up being a good year for us.
Yeah. Well, I want to talk through some of these different environments and how you view them.
Well, and so we were talking about
so it was 1 was premium capture, 2 market participation.
Right. So the third thing we're doing is an upside participation. And so what we're trying to do is set up positions so that if the market does kind of ramp up, we can take a little bit more advantage of that. So a structure we like for that is a call ratio. What we're typically doing there is we'll use what we call a 1x2. So we'll be long 1 call near the market and short 2 calls further out. Typically, those positions are about 2 months to expiration. The long is about 200 points out of the money, and the short is 100 points outside of that. So that position will be profitable all the way up to 400 points above the market. We typically do those 2 to 3 months in expiration, and we'll do them typically every other week. So we'll have 4 to 6 of those on at a time. So kind of every other week going out for 2 to 3 months. And then we'll stagger the strikes as well. So the first one the 2 month might be 200 points above the market, 2.5 might be 250 points above the market, the 3 month might be 300 points above the market, et cetera. So even if the market does really accelerate through that first earlier set of positions, we can capture the economics on the longer dated positions.
And do you view that as, so it's a bullish trade? It needs the market to move up in order to be profitable.
Right. And so we're doing those because we're selling to and buying one, the way we position them. We're doing those pretty inexpensively. We're typically getting them for, it's about $1, $1 to $2, depending really upon the vol surface and what's going on in the market. We've actually paid up a little bit for some recently, but typically they're pretty cheap. So even if the market doesn't, ramp up into that lower long position that we have, the economic impact is pretty modest.
And then that's a good example for people to try and understand. So I'm buying it for, call it $1.
Mm-hmm.
What does success look like there? You're selling it out for how much?
Well, we did well with those, say, in the second, third, fourth quarter of 2020, where we were buying them for $1, we were getting them for free. We started selling them out around $20. We were selling them all the way up into the 40s. I think the best we've ever done is 60. So, the economics can be pretty dramatic.
But at some point, if it goes through the upper strikes, it starts to come back down. It can go negative.
So what we're doing is we'll, depending upon where the market is and the time to expiration, et cetera, we'll be selling those out as they start to become profitable. Sometimes we sell too early. We rarely sell too late. We're taking economics when we can.
All right. Is there a fourth? I think you said 5 originally. This is the old who was that politician who said 3 things and could only remember 2 of them?
Yeah, well, there's actually 5, but so the fourth.
What was that guy? The Texas governor, Rick Perry. I think that's who it was.
Does he do that? So the fourth is downside protection, and there are a lot of ways we can protect against downside. When volatility gets cheap, we'll be buying puts. We can buy those outright. We can buy them in verticals. So we'll buy a put near the market and sell one further from the market to minimize the cost a little bit. We can do calendars where we'll say buy one for a month out and sell one for a month further out, or do the opposite depending on what the market, the economics look like. We like actually hedging by going long VIX futures. So we'll do that frequently, depending upon what the volatility space looks like. Sometimes we'll actually in fact, frequently we'll go short volatility. And when we do that, so we'll sell a VIX future. And when we do that, we'll take an offsetting position. And so there are 3 ways we can do that. We can sell volatility, say sell a VIX future and sell S&P futures against that, with modeling that there's a certain relationship between how much the VIX moves against how much the S&P moves. And so we're typically doing kind of 2 to 4 to 1. So we'll sell, say $1 worth of VIX futures, and we'll sell $2, $3, or $4 worth of S&P futures against that. Expecting that the S&P will go up less than the VIX will go down.
And
So,
so that's not necessarily part of the downside participation, but that's
well, it actually is in that you'll see it really earlier in the month where the market would actually move down a little bit, but we would make money on the decline in the S&P and lose less on the decline
on the short.
on the short VIX. And so when the S&P is down, 2 and the VIX is down 1, that would be a profitable trade for us. There were days actually when the VIX was high enough as a starting point where both the VIX and the S&P were down. So we made money on both sides of that trade. So the third way we do that is calendars. So we'll be short or long the front month and then the opposite on the back month. So for example, we might be short $1 of the VIX 30-day and long $1 or $1.10 or $1.20 of the VIX 60-day.
And do you view that as a long Vega or it's short? Like it's totally dependent on the curve?
It really depends on the curve. And what we really like to do is when you've got the right volatility structure, we like to take the opposite where we're long the front month and short the back month. And so that would be, what you call long Vega. Of course, if we're short front, long back, it would be short Vega. And then the third thing we do is we will go short volatility, but so that'd be just short a VIX future, but we'll go long VIX calls against that. And we typically do that in a pretty high ratio. So we'll be long VIX calls, 2 to 1, 3 to 1, 4 to 1. Currently it's 5 to 1.
And so in a March 2020 type thing, that's going to do much better than the short does worse.
Absolutely.
All right. So that whole bucket under downside protection is designed to be, if the market, and this happened with the fund in March 2020, right? If the market's down sharply, which we don't get too far in the weeds, but we do here on this podcast, so it's fine. But they have convexity, right? So you're maybe short the less convex thing and long the more convex thing. So
right. And so I think one of the key aspects of what we're doing, which again differentiates us from many of the others, like you mentioned, the hedged equity, is we'll move around. We'll change our portfolio based on where we are on that quadrant, on that 4x4 grid. And so, for example, in March of 2020, we went from being, short vol, short S&P to long vol, long S&P. And so we were losing money on our long S&P position, but we were making up for it in the long VIX futures position. And there again, it was it was about a 3 to 1 that we had. So we were long $1 VIX, long $1 of S&P, but the S&P went down 25-ish%. The VIX futures went up 400%. So we 400, 450. So we made 16 to 1 on our VIX futures, where we were losing 0.25 to 1 on the S&P.
And I want to circle back to that because I think that's important, but let's finish out your 5 pillars here. So
so the last, and this is really something that's profitable for us recently. We've been doing it for years, but it just hasn't really added much to our economics. Because what we're doing is in the derivative market, we don't actually purchase positions. We post collateral against those positions on margin. And the margin rates on the instruments that we trade is really very favorable. So it leaves us with typically 70 to 80% of our NAV in cash. The rest being what we post against collateral against our positions. So that cash recently, starting really kind of last year, is now earning interest income for us again. Starting last year, it was in the 2% range. It's got up to 4. I think we're getting 4 to 5% on our cash balance now. And so that just drops right to the bottom line.
Right.
Now, we've always done that. It was profitable for us back in the mid-teens, but then of course with zero interest rates, it really didn't add much for us.
So that's essentially like the fund is a 90-10 fund or something, right? Or a 75-25 cash alts fund, right? And that 75 is income producing T-bills.
It really is, and that touches on, what we think is an important part of what we're doing, which is, we want to have a return. We want to have a positive return. We want to do well relative to, what we look at really is not the S&P so much as a balanced portfolio, like a 60-40 portfolio of S&P versus debt. We're not really just looking at the return itself, but we're looking at the volatility of our returns versus the volatility of that basket. And we think because of these 5 components that we've got embedded in our fund, we really compare pretty favorably on a volatility perspective relative to that 60-40 basket, certainly than other funds.
Right. And I would, if I'm being critical, I'd say, okay, but I could just get the same, I could lower my volatility by just doing half the amount of S&P, right? And could I get the same or similar volatility if I just did half? But would you come back and say, well, yeah, but then you're not getting the ability to flip the sign in a big down move. You're not getting the ability in a flat market to earn some of this option premium, right? So help me understand that of like,
yeah, I think
why wouldn't I just do 40% S&P and get lower volatility and lower return? Like your pillar 2, like I could just do half the S&P and get nearly the same place.
I think you'd have to look at how the 60-40 performs versus some percentage of the S&P, and I imagine there's a point there where they equate, but the 60-40 is going to give you a lower volatility than the S&P itself will, whether that's just S&P or some percentage S&P. And we think that lower volatility is important because it lets an investor or a financial advisor keep their investor in the fund when times get really tough. So if you look back at times like, say, early 2020, when the market's down 20, 25, 30%, there were countless investors that would call up their financial advisor, do it themselves and just exit the market because they'd had enough pain. They don't want to deal with it anymore. And so they wind up, because of the volatility, getting out at exactly the wrong time. And the market turns around and goes up 30, 40, 50%. And so they turn around and get back into the market exactly the wrong time. And so the lower volatility, we think, lets an investor stay in and weather that storm a lot better.
And then, so talk through, we kind of hinted on it, like how you would expect the strategy in some different environments. So, right, like a 2017 type, very little volatility, markets just crawling, higher market. I think we went 11 out of 12 months and 6 months without a 1% down move in 2017. So that kind of market, you're probably in that most of the time in the up market, down vol quadrant, and are expecting to have that maximum market participation.
Yeah, that can be a very good market for us because our market participation is doing well. If the volatility is low, there aren't a lot of the volatility, if you will, is low, then we can do well with our premium capture. Our upside participation could be kicking in. We're wasting money on our downside protection, but the others should more than offset that. And then with high interest rates, getting say 5% on 70% of the portfolio can add 3.5% to the bottom line, before we do anything. So that can be a good market for us. I think really kind of the markets that are difficult for us are where, we kind of touched on this before, but it's really kind of where we get whipsawed. So, we go from an up market to a down market. So we're changing our participations and our structures and then we revert back to an up market, and then we revert back to a down market. And so the whipsaws can really wind up eating our economics. We had kind of a tough time in 2020. We outperformed the market, but 2022, we outperformed the market, but not as much as we would like. And really the reason for that is that while we're buying protection on the downside, as we entered the year, volatility was priced pretty high. In fact, it was probably pretty fairly priced, maybe even overpriced. So as we were buying protection, there really wasn't a lot of upside for it. There really wasn't a lot of room for it to go.
And then I know you said you're wasting money buying protection, but I know you don't really believe you're wasting that money, right? Because so you have this slow grind upward, probably going to be good for the strategy. You're going to almost max participation plus some option plus some T-bills. Slow grind downward 2022. You said not that great, but to me, like, you're only going to lose somewhere half-ish, right, of what the market did, because you're only participating 40%. So even if those option strategies don't kick in, they're not going to bleed enough to turn right into a full S&P loss or something. Right. I know, clients probably don't like that, of like, hey, I can't eat relative performance, right? It's the old line of like, great, you lost me half, but I still lost. And then the third scenario would be a sharp move downward. Right. So in a sharp move downward, that's where I come in. I don't think you believe that you're wasting money buying that downside protection.
Right. Well, right. I mean, I said wasted. It didn't fall down to our bottom line, but just like an insurance policy, when you're writing your check to Geico, if you haven't had an accident, you might, it was important that you had that position, but it didn't really do you a lot of good. But so a good market for us can be, a good example is early 2020, where we were coming into the year in a pretty normal environment. It had been pretty calm, so volatility was priced pretty low. The VIX was in the 12-ish range. And so as the market started to turn, it was a great opportunity for us to buy protection, very economically. And so we started buying those VIX futures as the pricing was around 16. And then the market just really started to drop. The price of protection and the VIX really took off. And so, the price of those positions went from, 16 to, I think we held on to them all the way up to 82. We added on the way up, but, we sold some out at the top, which was, they expired at 82. So it's, kind of a fourfold increase in the value of those. So that can be a good environment for us, where, you're kind of coming out of this, there's this calm before the storm, and there's an opportunity for us to acquire some protection inexpensively. And then of course the market just, flips, and we can take real advantage of that.
It seems like that's the answer to a smart ass like me, of like, why wouldn't I just there's plenty of things I could do to get less volatility, right? Why do I need to do all this? Like, well, because I can change the sign in a big down move like that, a big spike down.
That's true. And we do think we compare on a risk adjusted, so volatility comparable basis. We think we compare pretty favorably to, the 60-40 portfolio, which is really kind of our benchmark. We could look at different scenarios of how long you'd have to be the S&P to outperform us. I think you'd still have more volatility. But in fact, I'm certain of it. The only way you have to return and lower volatility is by adding that debt portion, which of course, hurts you pretty dramatically in 2022.
Right. A lot of those logic is based on before bonds were super volatile, right? So even if they're clipping along a nice return, if they're super volatile, it's going to make that portfolio a little more volatile, which breaks a lot of that modeling. Thoughts on 0 DTE?
It's an interesting space. It's not one we've gotten involved in yet.
Like crazy meme stock option traders, all that stuff.
Yeah, it's not our thing either.
Leave it to the pros. Have you seen
we don't
the
get involved in any of that?
there's a movie coming out about the GameStop stuff and
Oh,
that.
is there?
Oh yeah, it looks fantastic. Like it's got Ken Griffin and all the Fed and the guy from Melvin Capital, not themselves, but actors playing
That was
them.
an interesting story. Yeah.
So yeah, I'm gonna try and get
Sure,
that
there'll
going.
be some about crypto and SBF coming out as well.
Oh yeah, I'm sure they're lining up paying to get that going. Great, Russ. Well, this has been fun. Thanks for all the info. Tell everyone where they can learn more about the fund. We'll put it in the show notes, but what is it? AlphaCentricFunds.com?
AlphaCentricFunds.com. That's right. And we're the Premium Opportunity Fund. Our ticker is HMXI. The institutional shares are HMXIX. And all three classes are really available at the same minimum purchase amount. So even as a retail investor, there's no advantage to buying the A or the C shares. The I shares, I think, give better economics at the same entry price.
What's your just quick before we go, like what's your thought on you're running the private fund, each investor, maybe on outside your family and friends, people personally, and you're explaining it to them versus mutual fund model of you don't really know who's buying it or what their motives or questions are. Like, has that been hard for you, or it's recommended to recommend all fund managers do it?
No, it's interesting. I mean, I think the biggest difference between the hedge fund and what we're doing now, and we've been doing this since 2016, so coming on 7 years, is the daily price discovery. And so with the hedge fund, we had an entire month to work on achieving economics. 15 days after the end of the month, the economics would come out. A week or two after that, investors would want to talk to us. And so then, maybe they'd subscribe or redeem. They would put in the notice at the end of that month. And so then the funds would flow at the end of the following month. So really, there was kind of a 2-month window for ebbs and flows of economics. The communications around the fund were a lot more sporadic. Here, if we have a good day, investors see it immediately. If we have a bad day, investors see it immediately. We'll get calls from investors, well, not from investors, from FAs, asking, why wasn't the fund up more, or why was the fund down, or whatever, really kind of on a daily basis. And so we've kind of managed to work with the financial advisors so they kind of know what to expect, and they can moderate how they communicate with their investors a little better.
But it strikes me, what you were just saying, like it doesn't make sense a lot of time to judge funds like this and some other alternatives and options like on a day-to-day basis, right? Like if I sold this option with an expectation that it's going to do X over the next 45 days, on day 5, if it's losing money and I'm like, I'm out, right? That doesn't make a lot of sense. It's like being a distressed debt mutual fund wouldn't make a lot of sense, right? And like month 2, people are like, oh, this isn't working. Like, no, the whole point is we need time in order for it to play out.
That's exactly right. And that's the point of a kind of a low volatility, more lightly correlated fund. It's a long-term investment that lets someone put their money into it and watch it grow over time. If they're looking for, the fast, profitable trade, then, they've got to turn to the cryptos and the memes and things like that. And they can, maybe make 50% in a day or whatever the crazy numbers are. Of course, it works the other way as well.
Right. All right. The most important question, did you have all of your hair when you started this one?
I have a lot of it still. It's just a lot.
Yeah. Right. Because then we'd be really worried. Yeah.
I had as much hair as you at one point.
Whoa. All right. So there you go, folks. Don't be an option trader for a living. You might lose your hair. Hi, Russ. It's been fun.
Our hair, so you don't have to.
Exactly. Appreciate it. That is true, right? Like you're looking at all this day to day, you're taking on this volatility, you're analyzing it, right? So the investor doesn't have to do all that work.
That's right.
Awesome. Appreciate it. We'll talk to you soon.
Thanks, Jeff. Appreciate it.
Thanks, Russ.
Have a great day.
Okay, that's it for the pod. Thanks to Russ. Thanks to RCM. Thanks to Mr. Berger for making us sound and look good. We'll see you next week right here, and we'll be talking commodities and energy and crypto and all the rest with a longtime trader and friend of the pod. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlt and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.